So from Lecture 2, we have learned that governmental funds account for most of the day-to-day public services of general-purpose governments. For example, state, counties, and cities, they will have governmental funds to record a day-to-day basically service. Governmental funds are financed primarily by tax revenues, intergovernmental grants, and general fees, and this fund is controlled by legally adopted budget. We talk about budget in Lecture 3. There are several types of governmental funds. Typically, we're going to see the general fund, special revenue fund, capital project fund, debt service fund, and permanent fund. We're going to review these funds one by one. And for this lecture, we're going to focus on the general fund. Now let's talk about accounting basis for fund accounting, which is very different from the traditional accounting. So let's see where's the difference. Measurement focus of fund accounting. So for fund accounting, the measurement focus is a flow of current financial resources. The key word is current. Okay? So we're going to focus on the current expendable financial resources and also the current financial obligation, which is current liabilities. Revenues must be available to pay liabilities of current period before they can be recognized. So here, revenues must be keyword available. Okay? If we, for example, sell something to a customer and waiting for their payment, this revenue is not available. Okay? Because we haven't received payment, so we have nothing to pay our liabilities. So it's not available. Current financial resources include cash, receivables, marketable securities, prepaid items, and supply inventories. And these are the current financial resources or current assets that is measured in fund accounting. Capital assets such as land, buildings, and equipments are not accounted in governmental funds. Okay, because they're long-term assets. Long-term assets and also long-term liabilities are not covered basically by fund accounting. Rather, they will be covered in governmental the government-wide accounting. Okay, they will be recorded eventually. We're going to talk about that later. So these are the measurement focus. As you can see, it's very different from the general accounting, and therefore accounting basis will be a little bit different. We're going to follow the modified accrual accounting. So it's a kind of accounting that is mixture of the accrual accounting and the cash accounting. and we call this modified accounting. Now let's talk about what are those revenues we will see in fund accounting, general fund basically. There's two types of revenues. One is exchange transactions, in which each party gives and receives consideration of equivalent value. Okay, so typically, if we see business transactions, sell to customers, right? These are exchange transaction revenues. We also have non-exchange transactions, in which one party gives or receives value without directly receiving or giving equivalent value in exchange. Okay, something like you are sending free you're sending free goods to customers. That's non-exchange, right? And this happens in governmental accounting. Governments derive most of their revenues as non-exchange revenues, most, but governments also have exchange transactions because they also have business type activities. For example, most of the business type activities are recorded in proprietary fund. Okay. So for now, for the general fund, we will focus on the non-exchange transactions revenues. So what are the typical non-exchange revenues? Okay, we have imposed non-exchange revenues. These are the assessment imposed on individuals and the business entities. One typical imposed non-exchange revenues is property tax. Okay, property tax is assessed on individuals and business entities. Second, we have derived tax revenues. These are assessment on exchange transactions carried on by taxpayers. So it's derived from taxpayers' transaction. One typical is income taxes, when they provide service and receive pay. Okay, the government is going to assess a tax. Sales tax, when they purchase, okay, government is going to assess a tax on their transaction. That's derived tax revenue. We also have government-mandated non-exchange transactions. These are intergovernmental grants that requires resources be used for specific purposes, like a state may grant funds to a county for road improvements. And this is mandated because the county cannot refuse the grant. Okay, they have to take money and do the job. We also have voluntary non-exchange transactions. These are agreements entered into willingly by two or more parties. Okay, very similar to the grant. For example, the gifts to public universities. Unlike the mandated grant, okay, for voluntary non-exchange transactions, the receipt government is not required to accept award. For example, the public university can say no to the gift. Okay. So these are the four types of non-exchange revenues we're going to see in the general fund and also in other funds as well. Now let's talk about the rule, revenue recognition. So GASB statement number 33. Accounting and financial reporting for non-exchange transactions. Remember, we're using modified accrual basis. Under modified accrual basis, revenues cannot be recognized until they are both measurable and available to finance expenditures of fiscal period. Measurable and available. Revenue will be recognized when measurable. Okay, this is true for all accounting. But what's unique here is it must be available. Okay, in government accounting, it must be available. So what is available? Right? Collection of cash must be reasonably assured. And also we have a available rule, which means 60-day rule has become a benchmark. So for example, we assessed property tax, but the taxpayers, they didn't pay until, let's say, 1 month after the fiscal year period end. Okay? So generally speaking, right, because we have ended the fiscal year, and that's 1 month later. Those money, can we do anything about money received 1 month later? For the fiscal year, but fiscal year has ended already. Typically, that's not available for the fiscal year to spend in fiscal year because the year has ended, right? But we have this 60-day rule saying that if we receive the money within 60 days after the fiscal year end, these money should still be viewed as available for spending for that fiscal year. This is so-called fiscal 60-day rule. Okay, we apply 60-day rule for most likely for the property tax. Okay, for property tax. But some government have also established other rules, 30-day, 90-day, or even a 1 year time period is also available. But typically we have this 60-day rule. This is widely acceptable. And this statement identifies additional requirements associated with non-exchange revenue recognition. Okay, additional requirement. What are those additional requirements? Time requirements. The period during which resources must be used or when use may begin. For example, I received a grant. In 2020, I received a grant, but per contract, I can only use the grant in 2021. So I cannot use the money, use this resource, okay, in 2020. Therefore, this is not a revenue for 2020, okay, because it's time requirement. The money, basically, the resources cannot be used, okay, in 2020. So it's not a revenue in 2020. Only we can use the resource to cover expendable basically expenditures. Then we can use or record it as revenues for this year. This is time requirement. We also have purpose restrictions, which is the purpose for which the resources must be used. So a lot of times when we receive grant, we have these purpose restrictions. For example, the grant can be only used to purchase computers or purchase textbooks. Okay, this is purpose restrictions. The purpose restrictions will not affect the revenue recognition. Yeah, once we receive the grant, yes, we have a revenue, but we know it's restricted for that purpose. Okay, and become a restrict resources, and we're going to show that in the fund report eventually. So government should not recognize revenue or expenditures on non-exchange transactions until time requirement have been met. In the previous examples, right, I received money 2020, grant in 2020, but I can only use it in 2021, then I should recognize revenues in 2021, okay, until the time requirement have been met. And the government do not have to delay revenue recognition because of purpose restrictions. Okay, it does not affect revenue recognition. Some non-exchange transactions may be delayed until program eligibility requirements are met. One example is someone want to donate money to the university, but requires that the university sets up a new school, new department. Okay, so until the new department is set, right, then we can recognize revenue, the grant. Otherwise, before that, we cannot recognize revenue because we haven't, right, we haven't fulfilled the, we haven't been eligible basically to the grant. So let's take a look at property tax, which is the most important revenues for any government. So property tax is often viewed as a residual source of revenues. Right? Typically, the government is going to calculate the amount of revenue required, and then the amount of revenue required to cover all the expenditures, and if there are not enough money to cover all the expenditures, they're going to increase the property tax. It's called a residual source of revenues. Okay, so we do see changing property tax year by year. And how does the government determine the property tax? The gross tax levy is calculated as the amount of revenue required from property taxes, then divided by the estimated collectible portion of the levy. And this is often known as a mileage rate. Mileage rate is a tax rate used to calculate local property tax, which is $1,000 of a property's assessed value. Expressed as $1,000 of the property's assessed value. For example, a government needs $400 million in tax revenues, and its jurisdiction has $22 billion in taxable properties. Okay, then we're going to calculate what is per $1,000 property value tax rate. That's 400 million divided by 22. Okay, billing, and that's going to give us 18.18 mileage. In other words, for every $1,000 property value, the property tax will be $18.18. So what is the general recognition rules for property tax? Recognized in the year for which they are levied. This is general rule, okay? And we're going to see more details. Recognized in the year for which they are levied. So let's see this example. October 2019, city levies a property tax of $515 million for the year beginning January 1st, 2020. It estimates that $15 million balance will be uncollectible. Okay. So how to record revenues? Now its time is October 2019 and we levied tax. Okay, we just send out to the forms waiting for payment. And these are for the tax for 2020. Okay. What's the general rule? Right? Recognized in the year for which they're levied. So they're levied for 2020, but now it's only 2019. So we cannot recognize revenues yet. Okay? So the journal entry will be this. We debit property tax receivables. Okay, for the full amount levied. And we credit. Okay? A deferred inflow of resources. Right? We talked about deferred inflow resources in the previous lecture. This can be viewed as deferred revenues in accrued accounting. Okay, the idea will be the same. So they're not revenues, they're to be revenues soon. Deferred inflow of resources, property taxes, and which is the total amount levied less the uncollectible amount. And we credit allowance for uncollectible property tax, $15 million. Okay, this is journal entry for 2019. So no revenue will be recognized. Okay, because these taxes are not yet available to finance expenditures in 2020. If there's any discount or refund, we're going to record those allowance. Okay, allowance. And during 2020, right, it collects $410 million. So we're going to record the collection, debit cash, credit, property tax receivables. And because we have received cash and they become available to spend, we're going to recognize the revenue in the next journal entry with debit, property tax, the deferred inflow of resources. We're going to credit the property tax revenues. Okay, just like we do the adjusting entry for under revenue. Right? Now, $410 million are ready to finance expenditures in 2020. Okay, they are available now. It collects $30 million of the remaining 2020 taxes during each of the first 3 months of 2021. So January, we're going to collect $30 million, February $30 million, March $30 million. Okay, should we recognize revenues for 2020? Okay, so by the end of 2020, because we expect to receive $60 million within 60 days of the year end, right? We can apply the 60-day rule. Although the $60 million are not collected in 2020, they are still viewed as available to finance 2020 activities. So we're going to recognize additional $60 million property tax revenues. So we debit property tax deferred inflow resources and credit property tax revenues. So these are for January and February collections, but for the March collections, the 30 million to be collected in March, this is beyond 60 days. This cannot be viewed as 2020 revenues. Okay, they still remain as the deferred inflows. In addition, in 2020, it collects 20 million in tax applied to 2021. Right? Again, the money should not be available. The money is available, but we cannot apply it. The 20 million are not applicable to 2020. We can only use the 20 million for 2021 expenditures. So they're not revenues. Again, they're deferred revenue, deferred inflow resources. And taxes are due on December 31st of March of each year. And the government has a right to impose a lien on the tax properties if it has not received payment by that date. And we know that, right? So what's going to happen then? Remember, we levy 515 million. We only collect 410 million by the end of the year. So we're going to record the rest of the remaining balance as a property tax receivable delinquent. Okay, debit delinquent, property tax receivables, and credit property tax. That's $105 million. So the financial statement should clearly show what is not collected yet, right? And what has been collected, which is 410. Remember, we're gonna collect 60 million in January and February. So when we receive money with debit cash, we credit property tax receivable delinquent. The revenue has been recognized already, so we don't have to worry about revenues. And in March, we're going to collect 30 million again. So we debit cash, credit property tax receivable delinquent. But if you look at these journal entries, right, we do not recognize any revenues, either for 2020 or 2021. Okay, it's not a revenue anymore. It's neither a revenue for 2020 nor 2021. This is very unique because we're going to view it as unavailable for 2020. It's too late, but we cannot apply it to 2021 because basically this is a 2020 tax, right? And eventually we're going to write off the uncollectible amount, debit allowance for uncollectible property tax, and credit these property tax receivable delinquent. Write off uncollectible amount. Other issues with property tax: government may accrue interest, charges, and penalties on delinquent tax as they impose them. For example, if you want to impose a penalty interest, debit interest, and penalty receivables, okay, we're going to credit again a deferred inflows, right? Interest, penalties on delinquent taxes because we haven't, they are not available. Okay. Not available yet. The government may also add liens on properties by creating receivables, debit tax lien receivables, and credit property tax receivables delinquent, and interest and penalties receivables. So we're going to move all the receivables to the tax lien receivables. Okay, and eventually, the worst scenario is the government is going to take over and forced to basically the government is going to take the property over and sell it. Okay, and the government is going to take the tax lien back, and the remaining will be given back to the owner. Okay, and sometimes interesting stories. Property owners only own $1,000 or $2,000, but the property was sold, right, by the government, and owner suffered a huge loss. Those kind of story. Okay, so we're gonna we talk about that is for the fund accounting, the general fund. For government-wide statement, okay, for each government, when they consolidate all the fund together, they're gonna have a government-wide statement. For government-wide statement, it adopts a full accrue accounting. Okay, and this available criteria does not have to be satisfied in a government-wide statement. Now let's take a look at the same example to see what's going to happen under the government-wide statement. Under the government-wide statement, the city could recognize 500 million in revenues, okay, in a government-wide statement, because that's going to be expected to collect. Cities, it doesn't matter they're going to pay a little bit late. It doesn't matter because we do not apply the available criteria. Okay, so all the collectible amount, $500 million, will be recognized as property tax revenues. So as you can see, the difference between the modified accrue basis and accrue basis in this case is 30 million in tax property tax revenue. We're going to see many other differences, okay, between the modified accrues and accrue basis account. Okay, next, talk about fines and forfeits. And those kind of charges also important revenues for government. Fines are amounts assessed by the courts against those guilty of statutory offenses and neglect of official duties. And forfeits arises from deposits or bond made by contractors, blah 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 blah. Right? So governments should recognize revenues from fines and penalties as soon as they either receive their assets or have an enforceable legal claims to them. Again, as you can see, the rule is a little bit different from property taxes because the government, they have a strong enforceable legal claims. Right? The force is so strong that they are sure they will get the money back. The government, they're sure they're going to get money. So although they have not received, they still can recognize as revenue if they have an enforceable legal claims to them. Sales tax. Sales tax is a derived tax. It's based on the taxpayer's transactions, basically. In theory, derived tax revenues will be recognized when the underlying exchange transactions occurs. For example, when we finish the purchase, right, and the customer paid the sales tax, although the government has not received the tax yet, in theory the government may recognize the sales tax revenue. However, governments must rely on the merchant tax return to be aware of the tax revenue because they don't know that the amount, right? They cannot measure the revenue. And same for other derived tax revenues. For this practical reason, governments recognize these revenues in the period in which the taxes are collected. Okay, are collected. For example, in December 2020, merchant collect 20 million in sales tax. Of these, 12 million is collected prior to December 15th and must be remitted by February 15th, 2021. The remaining 8 million must be remitted by March 15th, 2021. So in this case, the 60-day rule applies only to property tax, but not to other revenues, generally speaking. And the government needs to make its own judgment as to what constitutes available. So in this case, the government has to make its own judgment, right? And some may say, okay, it's 12 million should be available, and others may say, okay, 20 million will be available. So it depends, really depends. So assume that this government adopts a 60-day rule for sales tax. In this case, it may recognize 12 million as sales tax revenues, and the remaining part will be a deferred inflow of resources, 8 million. And for the government-wide statement, okay, no longer apply the available criteria. We adopt a full accrual basis, and the whole 20 million will be recognized as sales tax revenue without any issue. Income tax. Income tax is another derived tax revenue. So let's see this example. In its fiscal year ending June 30th, 2020, the state collects 95 billion in income taxes for the calendar years 2019 and 2020. It refunds 15 billion of taxes based on the return filed by April 15, 2020. As a result of audit and prior year returns, the state bills taxpayers 10 billion for early calendar years. It collects 7 billion of this before its fiscal year end and expect to eventually collect the entire remaining $3 billion. Okay, under the modified accrual basis, revenue from income tax for the fiscal year, let's do the calculation, right? That will be the 95 collected, okay, less the refunded amount, $15 billion, okay, and plus the $7 billion, and plus the $7 billion. That will be $87 billion, okay? In other words, right, it's a little bit different here is the fiscal year across 2 calendar years. Okay, so don't get confused. $95 billion collected here are for the fiscal year, okay? Well, the fiscal year 2020, I should say, yeah, it could be fiscal year 2020 or 2019, depends on the government's policy. Usually, it should be fiscal year 2019. Right? It's ended June 30th, 2020. Anyway, so 95 will be recognized revenues without problems, less the refunded, It reduced the sales tax revenues without any problems. So the only issue is this one, right? This is a 10 billion build. Okay, these are the extra tax, billed to taxpayers. Probably they didn't pay enough tax. Under the modified accrue basis, okay, only 7 billion is recognized. Okay, because the 3 billion is basically unavailable. And under the full accrue basis or the government-wide reports, okay, the full $10 billion will be recognized. So the total income tax revenues will be $90 billion. And sometimes the government will sign a contract with specific taxpayers for tax abatement. In other words, they're going to pay a little bit lower taxes. In this case, it's like something you pay and they give you a refund, something like that. So for tax abatement, no revenues or expenditures will be recognized. Okay. Under the GASP statement number 77, but impact will be disclosed. Next, grants. So grants may be either a government mandate non-exchange transactions or voluntary non-exchange transactions, and we know their difference, right? Often the amount is known before the actual receipt of cash, and thus may be accrued under the modified accrue basis. So let's see how we're going to record our grants. For grant revenues, typically we're going to consider the following issues, right? Restricted grants, right? Payments intended for designated purposes, projects, or activities. And we have seen, right? Restricted grant may have purpose restrictions or time restrictions. And we have unrestricted grants. This is the easiest one. Also, contingent grant. So, grant contingent upon a specified occurrence or action on the part of the receipt. For example, before you receive money, they're going to ask you to do something. That's contingent grant. We also have the entitlements, payments from a high-level government to which a low-level government is automatically entitled. Right? These are typical grants we've seen from the federal level to state or from state to county. Right? Other issues. For voluntary non-exchange revenues from private organizations, we have typically we're going to see endowment. Okay, endowment is a very special grants. Typically for endowments, we cannot, right? The principal is basically restricted. Okay, we cannot. The receipt can. The receipt, for example, university cannot use the principal. Okay, rather they're gonna keep their principals, but the interest and dividend earned from the endowment can be used for designated purposes or become unrestricted and can be used freely by the university. So let's take a look at details about grants and how we're going to recognize grants. So generally speaking, grants should be recognized when the government has satisfied all eligibility requirements. Under the modified accrue basis, resource must also be available. Eligibility check and available check, right? So grants cannot be spent until a specific date are considered. to be subject to the time requirement, and therefore should not be recognized until that date. This is when we talk about that time restrictions. Until we meet the time restrictions, right? And to be eligible for reimbursement grants, governments must first incur the cost for which they are to be reimbursed. Hence, they should recognize receivables and revenues only as they make the related expenditures. Okay, this is reimbursement type grants. Okay, you have to spend money first, then you go back to ask money back. Reimbursement type grants. And in this case, okay, we can only recognize receivables and revenues, okay, after we spend money. And the amount revenues will be measured based on the expenditures incurred. Right? For example, you receive a $10 grant, okay, and you spend $5. Okay, you spend $5 under the grant, and for this year you can only recognize $5 revenues. Okay, although the total grant will be $10 because you spent $5. Okay, and if you only receive, let's say, $3 reimbursement from the government, okay, you still recognize $5 grant revenues because you spent $5. So the $2 difference becomes receivables, okay, from the government. That's the way we handle the reimbursement grant. Let's see a few examples to understand grants. Unrestricted grant with time requirement. Okay. October 2020, school district is notified that right, the state is going to award, right, $15 million in the system. The fund transmitted to the district December 2020, so it has been paid. May be used to supplement teachers' salaries. Right, the fund can be used only in the year ending December 31st, 2021. Okay, in short, in simple words, money received 2020, but it can be only used for 2021. Right, therefore there's a time restrictions for the year of 2020. We cannot recognize the grant revenue, right? The school district must defer recognition grant revenues until 2021. So it became the deferred inflow resources, right? Grant with purpose restrictions. So received the grant, right? Again, 50 million grant to enhance the school district's technology capabilities. The fund transmitted by the state in December 2020 must be used to acquire computers, but may be spent at any time. The keyword at any time. So there's no time restrictions, but there's a purpose restrictions. Can acquire computers. Okay. Purpose restrictions do not affect the timing of the revenue recognition. So the district should recognize revenue as soon as the grant is announced. The district should record a grant in a special revenue fund and report as restricted net positions in government-wide statement. Okay, it's restricted. The $15 million is restricted in this case. Reimbursement or eligibility requirement grant. Right, we talk about that. So the city is awarded grant a total of $400,000. It spent $300,000. for which it is reimbursed $250. Okay, so expect to be reimbursed for the $50,000 the next in January, and because this is a reimbursement type grants, city spent only $300,000 in total, so the city can recognize $300,000 in grant revenues. Okay, and debit cash, and there's a grants receivables $50,000. Okay. Pass-through grants. Many times the grants a government must transfer to or spend on behalf of a secondary receipt. For example, right, the federal is going to give the money to state, but it's just for pass-through purposes because money eventually will be transferred to a city, right, for example. So in this case, it's for the state, it's just a pass-through grants. The Gatsby stated that, as a general rule, the cash pass-through grants should be recognized as, okay, intergovernmental revenues and expenditures, or for government-wide its expense. In governmental, proprietary, or trust fund of the primary government and in the government-wide financial statement. General rule. General rule is will be recognized as revenues. Okay. There are exceptions. If government acts as a cash counter, so it's merely just to transmit money without having any administrative involvement, then these grants are reported in agency funds. Okay, agency funds is part of the governmental fund, but agency funds records resources outside. They do not belong to the government. Okay, the government just to take care of the assets, but it's not part of the government. So in this case, for sure, it's not a revenue, right, for the government. So key word here is no administrative involvement. Okay, so the government do not help pick the receipt or do not monitor whatsoever, just provide the bank account for transfer purposes. One example is food stamps. When a recipient presents a card to a merchant, where the state automatically recognizes both expenditures and an offsetting revenues. Right? This is a typical pass-through grants for the state because eventually, right, the federal government is going to give the grant to the state. So one revenues and one expense for these pass-through grants. That's for food stamps. Why they will be recognized? Because again, the state, right, has some administrative roles involvement in the food stamps, right? Donated capital assets. Donated capital assets should be recorded in either the fund to which they relate, if such fund is a proprietary fund, or in the schedule of capital assets, if such fund is a governmental fund. Why? Well, we need to record in different places, right? It's because, remember, for governmental fund, right? For example, the general fund or capital or debt service fund. But for the governmental fund, we do not recognize long-term assets. Okay, all the long-term assets will be shown as expenditure if we purchase. And in this case, if we receive, again, right, we do not show long-term assets in those funds. So it depends on which fund we use to record those donated assets. If it's recorded in proprietary fund without any problems, it's recorded as an asset. Proprietary fund is for business type of activities, right? We should be able to record our long-term assets. But if it's a governmental fund, these donated assets will be recorded in the schedule of capital assets. Okay, schedule of capital assets is additional disclosures. It's not part of the governmental fund. So in a governmental fund, donations of capital assets cannot be recognized as revenues. Cannot. But there is an exception. Except for donated assets held for sale can be recorded as revenues or deferred inflows, depends on the availability period. For example, right, the government received a donated land. So immediately the government decided to sell this land or put the land for sale. In this case, these donations will be recognized as revenue. Okay? If the government decided to use the land to build a park, something like that, not for sale, then these donations will not be recognized, cannot be recognized. Okay? We're going to show these donations only in the schedule of capital assets, additional disclosures. Exchange transactions, right? We have seen non-exchange transactions. The government is going to get most revenue for non-exchange transactions, but sometimes the government do get exchange transaction revenues, transactions in which each party receives value essentially equal to the value given when party sells goods or service and the other party buys. Right? Theoretically, we should recognize the revenues when it is earned and expense or expenditures when it is incurred. For exchange transactions, for example, the Gatsby statement says miscellaneous revenues such as golf and swimming fees, inspection charges, parking fees, and parking meter received. Right? All these are viewed as exchange transactions because the government provide a service. Okay. So we're going to recognize those revenues when cash is received. Cash is received. Okay. So here you adopt your cash basis. Cash is received for all the exchange transactions. Licenses and permits. So for licenses and permits, again, it's a little bit complicated because there's a unique characteristics about licenses. Okay, a licenses fee could be exchange transactions, in which the license fees, right, cover the cost of the license provided. Could be. But in most cases, it could be non-exchange transactions because license fees bears little relation to the cost of the service provided and imposed mainly as a source of general revenues. In most cases, it's true, right? And think about it, you get a license from the government and pay a huge amount of fees. What kind of services they have provided. Maybe just record a name and issue the license, maybe, but right. However, license fees are generally non-refundable. Okay, we have a lot of licenses, permits, fees. For example, the vehicle licenses, right? Business licenses, all these licenses. Okay, building permits. So fees for licenses and permits, right, should be considered exchange rather than non-exchange transactions, even though the party making the payment may receive less in value than it is surrendered. Okay, so this is what the rule says. Okay, it doesn't matter whether, right? For most cases, yes, it could be non-exchange, but we're gonna record those fees as exchange transactions, and if it is an exchange transactions, right, revenue will be recognized when the government received the cash. Okay. Okay, that's for revenues, and now we're gonna move to expenditures. Maybe you have seen two words, expenditures and expense, right, over and over, sometimes shown together. That's because these terms are used for different reports. For governmental funds report, we use the word expenditures. The definition here is expenditures measure, right, is a measure of fund liabilities liquidated with current sources. In other words, expenditures decrease in current financial resources. Okay, we use current resources to pay off current liabilities, and that's we get the expenditures. So if we adopt modified accrual basis, we use the term expenditures. Right? As you can see, the expense, the definition is broader. Right? Expense measures the cost expired or consumed during a period. It's a decrease in economic resources. Okay, now economic resources is much broader than the current financial resources, right? Because economic resources also include long-term, right? Long-term financial resources. So this expense is used when we have the government-wide statement or the proprietary fund, okay, which is business type fund, which records business type activities. For these financial statements, we're going to use expense. We're going to use expense. Okay, so we understand the difference between expenditures and expense now. So the general rule to record in expenditures, that's for government fund, is governmental fund. Okay, report only current liabilities and not long-term liabilities. Okay. Just like the revenue part, government fund only report current assets, okay, not long-term assets. For expenditures, the general principle of accrual accounting applies to governmental funds. For instance, we're going to recognize expenditures when cash is paid or a fund liability accrued for goods and service received. Okay, so basically it follows the accrual accounting for expenditure recognition. Still, there are some differences in liability accruals between the government and the business, or between modified accruals versus full accrual accounting. For example, claims and judgment, compensated absences, pensions, material supplies, prepaid items, debt service expenditures on government long-term debt and cap leases. With this topic, there are differences between the modified accrual and accrual accounting. We're going to cover part of them, but not all of them. It's a big topic. So the key difference is the government's liabilities are considered current only when they must be liquidated with expendable available financial resources. Therefore, if the government does not have a budget to pay, it does not recognize the liability. Okay, so if I owe you something and I do not plan to pay you currently, then I just do not recognize the liability and the related expenditure. I don't. So this is a key concept to understand. Okay? Any obligations that the government does not have a budget or does not plan to pay, okay, will be ignored basically. Now this is all because of budgeting, okay? The accounting here try to fit the budget, the budgetary accounting basically. So let's talk about salaries and wages. These we're going to follow the full accrual basis. So recognize expenditures in the period in which it is earned, okay, by the employee. Doesn't matter whether we have paid or not. For this particular account, we're going to follow the full accrual basis. Compensated absences. Compensated absences. Okay. In financial accounting, we know it's an obligation, it's a liability for a company. But let's see, government accounting, compensated absences will be the same definition, earned in one period, but often not paid until several periods later. Okay, and amount to be paid is often uncertain because salary will change. Usually salary wage rate will be higher when the employee takes off. So what does GASB say? GASB standard said, okay, vacation leave and compensated absences should be accrued as a liability as the benefits are earned in both the following conditions are met. And it is not easy for both conditions to be met. Not easy. 1. Attributable to services already rendered. Okay, this for most cases should be okay. The problem is second, probable that compensation will occur. Okay? Actually paid time off or other means. But it should be very likely that it will be paid. Okay? So in most cases, the second conditions will not be met. Okay? In government accounting. So let's see this example. City employees earn 8 million in vacation leave. Of this amount, they are paid 6 million in 2021 and postpone the balance into future years. The leave vests. So even if they leave the company, leave their organization, they still get it, and can be taken any time up to retirement or as additional compensation at the time of retirement. So obviously 8 million has been earned vacation pay, but the probability of paying 6 million has been paid already, but the probability of paying the remaining $2 million, we don't know in the future. So obviously for governmental accounting, we can only recognize 6 million expenditures. The 2 million we should be ignored because we don't know when it will be paid. We don't know. So we're going to ignore their liabilities. But in government-wide statement, which follows a full accrue basis accounting, okay, the $2 million will be accrued. Okay, the total expense will be $8 million. The $2 million will be recognized as a liability. That's a difference. Sick leave. Sick leave is beyond the control of both employee and employer. So Gatsby says that sick leave is recognized as a liability only if it is probable that employer will compensate employee for the benefit through cash payments conditioned on the employee's termination or retirement. Okay, the key here is on the employee's termination or retirement. If they don't quit or they don't retire, then we do not recognize sick leave liability and expenditure. It should be recorded only when expected to be paid, okay, to the employees upon their resignation or retirement. So the idea will be the same as the compensated absence, right? Only when they expect to be paid. If you don't have evidence to show that it is expected to be paid, then we're going to ignore it. So in the previous example, if the government does not budget the termination payment, okay, it records no liability. It records no liability in governmental fund. But, however, this liability will be reported in the government-wide statement, okay, because it uses a full accrue basis accounting. So the idea is very similar for these compensation, right? If the government does not have the budget or does not plan to pay for it, okay, just ignore it in a government fund. Sabbatical leave. After a specified term of service, employees may be granted a paid leave, especially for government employees. Okay, they are offered to benefit both the employee and employer in the future, not the past. Because during the sabbatical leave, the employee is going to improve or learn something new that can be used in the future, that can better serve the employer. The employees are required to perform other activities that will enhance the job's related abilities during their time off. So the Gatsby says, the accounting depends on the purpose of the leave, okay? If the leave is restricted as to purpose, i.e., for instance, activities to enhance their job-related skills, then they are accounted for in the period the leave is taken. Basically, we're going to debit sabbatical leave expenditures and credit cash. Okay, this will be the same for government-wide reporting. Okay, because it's a kind of expenditure for the company to improve employees' skills, basically. If the leave is compensated unrestricted time off, okay, it's kind of benefit. Employees can do whatever they want during the break. Then the related liability is accrued during the period the leave is earned. Okay, again, governmental fund typically does not recognize this liability. and only government-wide statement report is this liability. Okay, so the idea is consistent. Usually the government fund is going to ignore those liabilities because they don't know when to pay, or they don't have the budget to pay. Claims and judgments. And in financial accounting, we know these are contingent liabilities, right? What does a GASB say? GASB statement number 10. Liabilities will be accrued if probable that asset impaired or liability incurred by balance sheet date and loss can be reasonably estimated. This is very similar to the financial accounting. So what is expenditure amount? Well, recognized in the governmental fund only the portion of the liability that is normally to be liquidated with available expendable financial resources. Again, the same logic applies here. Okay, only when the government plan to pay those liabilities, then they will recognize. Otherwise, they're going to ignore it. Okay. Right. However, in the government-wide statement, this liability will be recognized. Okay. Example: a county is sued for personal injuries. The case is settled for $400,000 to be paid in 4 annual installments of $100,000 beginning immediately. Inasmuch as the county uses a discount rate of 10% to evaluate all long-term projects, we should determine the present value of the eventual payment to be $348,685, which is the present value of the 4 installment payments. Present value. Okay, in fund accounting, the journal entry is very straightforward. Okay, because the government will not have budget for future installment, so we're going to ignore the liability. We only record the current period's payment as an expenditure. So for this period, only recognize $100,000 expenditures, credit cash. But for government accounting, for the government-wide accounting, because we're using a full accrual basis, the whole liability, the 4 installment, will be accrued. So for this period, we're going to pay 1 installment, and the rest will be recognized as a liability. The 3 future installment will be recognized as a liability. Okay, and then record total expenses as the present value of the 4 installment. Materials and supplies, they are not expendable available financial resources. Okay, inventories are not expendable because they are inventories. You cannot basically very difficult, I should say, settle liabilities with inventories. Neither can be transformed into cash nor be used to satisfy government fund obligations, therefore they are not expendable. Unlike business, governments do not acquire inventories with the intention to resell them. They use it to carry out day-to-day operations. The 2 primary issues pertaining to governmental funds for supply or inventory accounting are the timing of the expenditures, when they acquire. Okay, when they acquire inventories or supplies, right, they may record an expenditure, or when the government pays for the inventory. they record expenditure, or when the government uses inventories, they record expenditure. Which one? Which one we need to follow? Okay. And then how to report asset. Accounting for inventory basically has two methods, the purchase method and the consumption method. Okay, both are available for government accounting. Under the purchase method, we're going to record expenditure when inventories are purchased or supplies are purchased. So when we purchase supplies, we're going to expense them totally. Okay. Then by the end of the period, if we have remaining supplies, we're going to reverse, we're going to add them back to the statement, to the funds. You can add them back to the funds. The next is consumption method, which is preferred. And this is consistent with the financial accounting. Right? We record our supplies or inventories as an asset when purchased. Then when we use, we book an expenditure. Right? This is preferred. Let's see this one. The following information is given. That's for inventories. Begin with inventories 20,000. Then new purchase 150,000. So we have 170 available. Then we consumed some. End up with 15,000. Okay, then we do the calculation, the amount consumed during this period, $155,000. Okay, let's see how we're going to record all these transactions. First, recorder under the purchase method. Under the purchase method, right, when inventories are purchased, we're going to record an expenditure. Debit supply expenditures, credit account payables. Then at the year end, right, 15,000 remaining. We're going to add 15,000. Then right, add 15,000 back to the funds. Debit inventory 15,000 and credit fund balance non-spendable. Okay, because this inventory is non-spendable. Okay, this fund is non-spendable. Remember, we talked about the restrictions of funds. There are several levels. This is non-spendable. However, this conflicts with the GASB standards. But still some governments continue to use this purchase method. Okay? So if someone uses purchase method, you know what they're doing. Then consumption method is easy to follow. Right? When purchased, we record an asset, supply inventories because they're current assets. And during the period, I'm going to record as expenditures. Okay, and a very important step is this one, adjusting entries. After the year end, we're going to adjust the fund balance for inventories. Okay, I'll go back. Let's see the question. So at the beginning, we have 20,000 beginning inventories, which means at the beginning fund balance, okay, we have 20,000 unspendable fund. Right? Now, by the end of the period, we have 15,000 remaining inventories, meaning, right, our inventory balance has been reduced by $5,000. So it's going to release, okay, it's going to release the fund from non-spendable back to unassigned. Okay, release the fund from non-spendable. In other words, inventory take right, the amount of resources occupied by inventory has been reduced, right? So we have more funds that is unassigned we can use for other purposes. Okay, this is a very important adjusted interest if we use consumption method. The government-wide, we know we can follow this method, okay? Follow the consumption basis. Prepayments. Okay, GASB standards for prepayments. You can either use for fund statement. You can either use purchases or consumption method. Okay, just like inventories. But for government-wide statement, only the consumption method must be used. In other words, recognize an asset, right? Then when we recognize expenses. Then at the end of the period, adjust the fund balance. Okay, either increase unspendable or decrease unspendable. And you may wonder, some of those prepayments are long-term prepayments, prepaid 3 or 4 years insurance, but the government fund do not recognize long-term assets. But there's a problem, right? But GASB does not distinguish between current and long-term prepayments. So all the prepayments will be viewed as a 1-year policy, current as the current assets. Right, examples. On June 15th, 2020, the city acquired and paid for insurance policy cost $300. Okay, obviously this is a prepayment. The policy covers a 2-year period beginning July the 1st. Right, purchase method will be record expenditures immediately, but under the consumption method, it's recorded as an asset first. Okay, that's a difference. Other expenditures in governmental fund. What are the other expenditures? For governmental fund, we have other fund, right? Debt service, the capital expenditure. So for capital assets expenditures, okay, because the governmental fund does not recognize long-term assets, for capital asset expenditures will be reported. Okay, capital assets are reported on the general fund balance as an expenditure. Okay, and because it's expenditure, there's no depreciation for that. Okay, rather it will be the amount of capital assets purchased will be recorded and disclosed in additional disclosures. But if we use a proprietary and fiduciary fund to record a capital assets purchase, then we will show the long-term assets on those funds, because that proprietary and fiduciary, they can use full accrual basis accounting. Okay, only the governmental fund, okay, we're going to use modified accrual basis. Capital lease expenditures for governmental fund, yeah, it's an expenditure. Although if we follow the full accrue basis accounting, we're going to recognize an asset, right? That's capital lease. So we're going to talk about that in next 2 lectures. Grant expenditures. Just that symmetrical rule of revenue recognition. The party who received grant, that's a revenue, so the party who give the grant will record an expenditure. Right? For example, grant paid with time restrictions, I'm going to debit deferred outflows, credit cash. Why? Because the metric rule of revenue recognition for the receipt, right? When there's a time restrictions, right? They cannot recognize revenues, but for this party who make the grant, right? Also cannot recognize expenditure. Rather, it becomes a deferred outflow. Okay, deferred outflow. It's not expenditure yet. Other financing sources and uses. Okay, if you read the fund statement, in addition to the expenditures, revenue expenditures, you may also see other financing sources and uses. What are these things? Governmental funds receive or use resources from transactions that, under the full accrue basis, would affect long-term assets or long-term liability accounts. Okay. For those transactions, if we are increasing our long-term assets or long-term liabilities or decrease for example, if we borrow money, right? If we borrow money, it's going to increase our long-term liabilities under the full accrue basis account. But because we do not recognize long-term liabilities in governmental funds, we're going to call these other financing sources. Other financing sources, right? We are borrowing money. So one example, if the government purchased capital assets by issuing a bond, we know it's going to debit capital asset expenditures, right? And we're going to credit other financing source. Okay? It's not a revenue expenditures. It's just a way we record the change, okay, in long-term assets and long-term liabilities. But we do not call them long-term assets or long-term liabilities. So what are the sources we're talking about? Other financing sources. You have proceeds of long-term debt, proceeds from the sale of capital assets, right? The present value of liabilities created by capital lease and non-reciprocal transfer in. All these are other financing sources. So where we get money from? By borrowing money or signing a capital lease, right? Or by selling capital assets or receive a transfer in. This is a transfer from other government organizations. What are other financing uses? One typical one is non-reciprocal transfers out is other financing uses. Or payments to bond escrow agent who maintains accounts for the eventual repayment of long-term obligations. Right, money you want to escrow account will be other financing uses. Because it's not expenditure, right? It's still your money, but eventually they will be paid. But if you wire them out, it's other financing uses. All right. So, reporting. How do we report revenues, expenditures? Revenues, expenditures, and changes in fund balances in governmental fund in a statement that takes the following form. Right? We're going to report revenues followed by expenditures, and we have the excess of revenues over expenditures. Then we're going to report other financing sources and uses. The net, okay? Obviously, this is a net other financing uses, right? Net uses. Then we're going to report some special or extraordinary items. Special and extraordinary gains and losses. Special is either rare or infrequent, then extraordinary is both rare and infrequent. Although in financial accounting we have removed this difference, these will be reported same in financial accounting. But for GASB, we still differentiate between special and extraordinary items. Right? So then we have the net change in fund balance. Net change in fund balance. If we add the beginning fund balance, we're going to have the end of the period fund balance. This net change in fund balance is very similar to the net income. Net income. All right, this is pretty much for this lecture. Okay, this is a very important lecture. Maybe it takes a little bit longer to study, but I suggest you spend a little bit more time on these two topics: revenues and expenditures or expenses. We're going to see these topics again. Okay.